Hi, and welcome to our video on financial derivatives. Financial derivatives are financial instruments whose value is derived from an underlying asset or set of assets. The most common types of derivatives are futures, options, and swaps. Derivatives can be used for a variety of purposes, such as hedging risk, speculating on the price of an asset, or obtaining financing. Derivatives can be complex and carry a high level of risk, so it is important for investors to understand how they work before using them. There are several types of derivatives, including forward contracts. These are agreements to buy or sell a specific asset at a predetermined price at a future date. Options. These give the holder the right, but not the obligation, to buy or sell an asset at a predetermined price on or before a certain date. Futures contracts. These are standardized agreements to buy or sell an asset at a predetermined price on a specific date in the future. Swaps. These are contracts in which two parties agree to exchange cash flows or underlying assets at predetermined intervals. Warrants. These are long-term options that give the holder the right to buy or sell an asset at a predetermined price. Convertibles. These are securities that can be converted into another security, such as a bond or stock. Credit default swaps. These are contracts that protect the holder against default on a bond or other debt security. Weather derivatives. These are contracts that allow companies to hedge against weather-related risks, such as extreme temperatures or natural disasters. A future is a contract to buy or sell an asset at a predetermined price on a specific date in the future. For example, a farmer might sell a futures contract to a grain elevator, agreeing to sell a certain amount of wheat at a fixed price on a specific date in the future. This allows the farmer to receive a guaranteed price for the wheat, even if the market price of wheat fluctuates between now and the time of delivery. An option is a contract that gives the holder the right, but not the obligation, to buy or sell an asset at a predetermined price on a specific date in the future. For example, a company might buy a call option on a particular stock, giving them the right to buy the stock at a fixed price at any time before the option expires. A swap is a financial instrument in which two parties agree to exchange cash flows based on the performance of an underlying asset. For example, two companies might agree to a currency swap, in which they exchange cash flows in different currencies to hedge against exchange rate risk. Financial derivatives can be complex and carry significant risks. It is important for investors to fully understand the terms and conditions of a derivative before entering into a contract. One thing that may not be widely known about financial derivatives is that they have a long history, dating back to ancient civilizations. For example, derivatives in the form of forward contracts were used by ancient Babylonian traders to hedge against the risk of crop failure. Another lesser-known fact about derivatives is that they can be used for purposes other than just hedging or speculating. For example, derivatives can be used to transfer risk from one party to another, to raise capital, or to create synthetic exposures to certain assets or market conditions. Additionally, the use of derivatives is not limited to financial markets. Derivatives are also used in other industries, such as agriculture, energy, and real estate, to manage risk and facilitate trade. Overall, while financial derivatives are often thought of as complex and risky instruments, they can serve a variety of purposes and have a long history in commerce and trade. That concludes our video on financial derivatives. Thanks for watching.